All right, James, we're going to talk about Buffett, who you've been writing a lot about recently. And we know that everybody always follows, and I think you did say this in your latest article. Obviously, people follow what he does, what Berkshire has in their portfolio. And specifically, you were talking about what he's done with his largest holding, which is Apple. So maybe let's just start with what happened first, and then we can talk about what you think about that and how investors should think about it.
So with Apple in the third quarter, which he just announced in terms of earnings as well as other things, he took down the Apple stake over that quarter by about 25%. And in the previous quarter, the second quarter, he'd cut it by 50%. So all up, as of this year, I think it's around 66% in terms of his stake has gone down in Apple over that time. So over the 9 months to the end of September, he's cut that stake very significantly. And that was his largest holding by far. It still is his largest holding, but he's cut it significantly down. Now, I think there are a few different ways to interpret this. And I wrote at the end of the second quarter that I thought he was going to cut more because the Apple investment didn't really stack up anymore for a few reasons. And I got criticized for that because people said, well, he still owns a lot of Apple, which was fair enough. And therefore, he might be just trimming after it having run up since he started buying in 2016. That was one view. But I thought that the actual fundamentals of Apple had deteriorated, and that was part of the reason why it was selling. And there were a few reasons in terms of those fundamentals. They are one, that the valuation for Apple is very high. It's in the mid-30s PEs. It's not really growing earnings by much these days. It was previously, less so now. It's really in the single digits and not really growing much going forwards unless AI really takes off. We'll see about that. Also, more importantly, I pointed out something that I don't think a lot of people picked up on, that Apple had continued to buy a lot of shares. And Buffett had previously praised that. That's one of the reasons why he was buying it, because in 2016, when he started buying, Apple was cheap. At one stage, it was on single-digit PEs, if you can believe that. And they were buying back stock through those years subsequently very aggressively. And he loved that because if you buy back stock at cheap prices and they increase, obviously, that's money well spent. Nowadays, they're buying back stock at 35 times earnings or whatever it is now. It's a different proposition from buying back when it's 9 times earnings. And I just think that in Buffett's eyes, he views capital allocation from CEOs as very important, and that I would foresee that he wouldn't like what they're doing right now with that cash in terms of buying back shares at these prices. So for all of those reasons, I think he was cutting back that Apple stake and may continue to cut it back more.
And I think the interesting thing, and we'll get back to Buffett and Berkshire, but Apple in many ways has kind of the same problem that he does. They still generate a lot of cash, and they don't really know what to do with it. So it's kind of the challenge he's facing. Now they've done something differently with it, but yeah, it's interesting, those two companies looking at them side by side.
Yeah, and you can view capital allocation through that lens. What do you do with such a large amount of cash? Now, they're obviously investing a fair bit into AI and other technology that can drive earnings going forwards. They are paying some dividends. They can buy back shares. They can also potentially do mergers or acquisitions as well, which they haven't really been that fond of. So there are a number of different options, but when that cash pile grows so large, as it is in Apple's and Berkshire Hathaway's case, it gets more difficult to get decent returns on that cash, or in terms of paying out dividends. That also has tax implications. So it's a complicated decision. But I just don't see that he thinks that buying back shares at this stage makes any sense whatsoever. And he's actually doing something very different, which we can talk about a bit later.
Yeah, so why don't we dive into that now? Because one of the challenging things is we obviously don't know exactly why he's selling. We won't know what he ultimately does until he does it. But you did talk about what has happened. So where has that cash from this enormous sell down of Apple gone?
So in the third quarter, that sell down, he sold also some other stock, particularly Bank of America, and he has now around 325 billion US dollars in cash. And of that, around 288 billion he's invested in short-term treasuries. And that's an interesting move in itself. It's basically a pretty safe option. It's not long duration bonds, it's short duration. In essence, it's like a cash substitute for him.
Yeah, like very liquid, right? He can get out of that pretty easily, obviously, if he wants.
That's exactly right. It's almost like a holding pattern in terms of his position now. So that's what he's doing with that cash right now. And, it's very different to what Apple was doing. Apple was buying back its shares. In the third quarter, for the first time since 2018, Berkshire decided not to buy back its own shares, which is clearly pointing out that he thinks the stock is fairly or overvalued, his own stock that is, and that it's not worth buying at the moment. So he's halted share buybacks of his own. So it's a very different strategy that he's employing.
And one of the interesting things I think about anytime Berkshire sells something is Buffett. There's all these very famous investing quotes attributed to him. His favorite holding period is forever. Pretend like the share market would be closed for 10 years. So I think, as you said, this is a big signal that, something, either with Apple or perhaps the overall market, is not to his liking if he's going to make moves like this and start selling shares off.
He said at his annual meeting in May that he can't find anything to buy with the cash. He's been looking, he just can't find anything. And that's part of the issue, and that's a broader issue about valuations in the market and what he can buy, and also is the sheer size of the acquisitions that he would have to make with that cash. And you're right. I mean, people do speculate on why he's doing it. But if you look at, for instance, his cash pile as a percentage of his total assets, they're at around 28%, which is a record high. The last time it was near this vicinity was in 2005. And we know what happened after that. It was around 25% it peaked at. He actually did that dropped a little bit down to 18% in 2007. So we actually started buying stuff in 2006 to 2007 as the share market started to deteriorate. And so he was a bit early. And then he bought obviously a lot more post GFC with the cash that he had.
Yeah, and maybe seeing that scenario again, obviously, because during the GFC, like famously, obviously, it was very difficult, particularly for banks to raise funding. I know you went in and I think they were preferred shares, but gave a bunch of money or invested a bunch of money in Goldman when they needed to raise capital. And so perhaps this is what he's foreseeing.
Well, I don't know if he's foreseeing a GFC, and I doubt it. That kind of thing's normally a 1 in 50 or 75 year event. But he's, how I would put it is that I think it's pretty clear he's playing more defense than offense. And I think throughout his career, he's shown that he knows when to go aggressive or when not to. And I think this is one of those times where he's clearly signaling where it's time to play defense. With Apple, it's a bit more nuanced. As I say, I think that he's not only cutting the stake for potentially market reasons, but for Apple-specific reasons, I think more so. He would hold on to that if the fundamentals probably did stack up. But I think that he's suggesting that they may not be any selling stock on that individual basis.
Yeah. And one thing I thought was interesting in your article is one of his longtime holdings is famously Coca-Cola. And you did point out that he has said in the past that, Coke reached a extremely high, I think the late 90s valuation. And he did say, I wish that I had sold. Just given how expensive it was from a valuation perspective. And then I don't remember the exact amount of time, but it was something like 16 years for the share price to get back to that high. So maybe he's taking some lessons from his own history as well.
I think you're right. He has regretted that. He's said that on a number of occasions. He knew that Coke, I think, was valued in around 50 times PE or something it got up to in 1999, 2000. So it was very expensive. He knew it. And I also point out in the article that more broadly, he was warning about a toppy market at that point. He did a number of talks privately to investors that eventually got out into the media, including to tech executives, which didn't go down well at the time, that he thought some of what was going on was ludicrous and that people would regret it later on. And it didn't take too long after that for things to start falling apart.
How do you see Buffett? Because you did describe him in the article as a value investor, and kind of his, you mentioned some of this history, obviously under Ben Graham and sort of that deep value cigar butt investing, and then sort of the popular story is, he meets Charlie Munger at this dinner party in Omaha, and Charlie's like, well, okay, like don't just buy companies like this, let's buy growth at a reasonable price. Great companies at a reasonable price. I mean, how would you see him? Do you see him as a pure value investor?
I see him as both. I don't think there's a distinction in some respects. The two factors kind of coincided neatly in that I mentioned 1968 when he shut down his fund. He realized then that cigars,
the cigar butt investing,
wasn't going to work with more money. So at that time, I think he had about $105 million at play, which was a reasonable at that time, and he was struggling to invest it. So I think he was realizing already that with larger amounts of money, that style of investing had limitations. And at the same time, he'd met Charlie Munger, and Charlie Munger was in his ear about buying at a reasonable price, and he foresaw potentially that was the way to go going forwards. And then that transferred into his investing in the early 1970s, and he bought See's Candy famously, and that was a bit of an epiphany for him, I think, in retrospect, if you read some of what he's written and talked about since, in that he was a company that was a growth stock, a reasonable growth stock, and he held it. He still holds it, and as that played out, I think that confirmed that belief in that style of investing. But value and growth is kind of an interesting one. I don't think they're separate. He still wants to buy cheaply. He won't buy expensive stuff. He wants to buy stuff, as you say, at a reasonable price. He'll pay for that growth. And the other thing to mention would be that he's always been an investor, and I think this is really ignored. He views stocks in some ways a little bit like a bonds plus strategy. What I mean by that is that right now he's investing in bonds. He thinks that, in essence, that bonds returns are on a risk-adjusted basis better than stocks. That's the call, in essence, he's making by investing $288 billion in short-term treasuries. He wants to buy a stock that's returning, giving him a premium above those bonds, and with a certainty that he can look out over 10 or 15 years and he's going to make a ton of money in a relatively safe way. And if you look at a number of those investments, whether it's See's Candy, whether it's Washington Post, whether it's Coca-Cola, they had quite predictable earnings that he could have a reasonable guess at over 10 or 15 years, and that he would have stable kind of returns, and he would make a lot of money as a consequence. And he was buying them at a good price.
Yeah. So he's known, obviously, as the Oracle of Omaha, that investors, as we were talking about, try to interpret everything he does. There are countless quotes attributed to him. What lessons, because you did outline some lessons for investors from this sale of Apple and some of the stuff Berkshire and Buffett, of course, are doing, What are those lessons? What can investors take from this whole episode? I know you've probably mentioned some of them in our discussion, but yeah, what can investors take from this?
I think it's that there are times to be on defense rather than offense. It doesn't mean making big calls about a market, that it's, going to crash, or that it's a great buy from here. He's basically saying, look, there's more risks now. There may not be at another period where there's less risk, and he'll be aggressive in those periods. So I think that's the main takeaway. But as an individual investor, do you sell stocks as a consequence? That's what people will be asking. Well, I'd be saying, look, if you have a stock that's at 50 or 60 or 100 times earnings, there are risks there, and you may want to think about that. And this might be the time to do that. That's, I think, one of the main lessons that Buffett is teaching, is that if stocks are expensive and fundamentals are deteriorating, then it's time to think about selling. And that's the lesson that he's learned. But I wouldn't say dump everything. Over the long period, staying invested pays off. And I wouldn't be cutting and running as a consequence just due to Buffett.
Yeah, exactly. And, obviously there's lots of implications around taxes, depending upon your cost basis, how long you've held it. And then, of course, market timing works great in theory, but it's very, very difficult to do. So, yeah, challenging always to navigate all these different signals we're getting. And that's why I guess investing is fun and hard also.
Yeah, it is. I would say study the best investors like this, but don't take extreme actions because of it. Think it through. Normally, being black and white isn't the way to go. You can buy and sell at the edges on these kind of things, but on the whole, stay invested.
Yeah. And personally, the lesson I got is I'd like to increase my cash holdings to $350 billion. And I think then I would not have to worry about the share market. But anyway, James, thank you very much for joining us. Great article. So everyone give that a read. But thank you.
Thanks, Mark.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.